Hi, and welcome to Macro Wednesday, where we talk macro, try to make sense of markets, and they don't really make any sense. And more importantly, answer your questions so we can become better investors. I'm your host, Steven Van Metre, and thanks for being here with me today because I have a great show lined up for you. In fact, we're going to try to answer a very important question, and I want to see if you can guess, or maybe you know. The answer to today's question is, how did Fed Chair Powell screw up? What did he do, or what didn't he do? How did he screw up? Do you think you know? I'm not going to tell you just yet. We're going to save it to the end of the show just to see if I remember and to see if you can guess. You want a hint? All right, I'll give you a hint. Okay, this is a good one. Former Fed Chair Janet Yellen would not have made this mistake. Ooh. Didn't see that coming, did you? Now, if you thought, I didn't watch the Powell testimony in front of the House or Senate, yeah, you didn't have to. This question is not dependent on that. I didn't watch the last press conference. Yeah, I didn't have to. What did Powell do? How did he screw up? What did he do? Or is it didn't he do? All right, let's get into the macro data because there's some really cool stuff I want to look at. I've got tabs full of charts to look at. So let's just go through and see what we can learn from macro perspective from the last couple of days since we were here together. So let's go back to Tuesday. And as you look at the data, and you can go to investing.com under their economic calendar, there's another website. I'm not sure what it is, but it has effectively the same data on it. And let's start with Japan. Now, coming out of Japan, the exports were down 28.3%. Imports coming into Japan down 26.2%. So when we're looking for a V-shaped recovery, or at this point, any recovery, and you go from the exports fall from, say, 22% to 28%, that's not a V-shaped recovery. How about if imports go from -7 to -26? That's not a V-shaped recovery. So when you look at Japan, a major exporting nation, and you see that these numbers are down, it tells you there is no recovery going on, at least in Japan. How about Singapore? Non-oil exports down 4.5% on a year-over-year basis. Went negative from last month, which was positive 9.7%. Let's move on into Wednesday morning where we get some CPI data. Let's see what's going on around the world. Great Britain CPI slowed from 1.4 to 1.2%. Again, with consumer price index, it's the trend. It doesn't need to just fall off a cliff from one month to the next. But we want to see what is the trend. Let's see what else we have. Producer price index. So input coming in, producer prices coming in. We're minus 10.2% last month, minus 10% in May. Again, producer prices falling coming into the factory in Great Britain. How about coming out of the factories at Great Britain? PPI output went from minus 0.07 in April to minus 1.4% in May. Again, these are deflationary prints. And when you see deflation, I like to think of deflation as the drain on your bathtub. And you pull the drain and the water swirls and goes down. It's not easy to stop until you plug it. But deflation, much like inflation, persists until it stops. And that's the thing. Some people are like, it just stops. If we get one good report, no. It doesn't just stop. So what we're looking at to see is if this trend is continuing around the world or somewhere that is going to stop. How about we move into the Eurozone? Industrial new orders from out of Italy down 49% on a year-over-year basis in April, falling from minus 26.6% the month before. That is just wild. Industrial sales out of Italy in April, minus 46.9%. Now, granted, we do expect bad news in April, so we'll see how May's numbers improve. How about Eurozone? Consumer price index, flat at 0.1%. Core CPI, which is excluding food and energy, flat at 0.9%. So at least as the overall Eurozone, the CPI seems to be fairly flat. Let's move into the U.S. data. We have the MBA mortgage applications. I thought there was something else I was looking in here. And no, I thought there was. But there's not. All right, let's move into the Oh, where's the retail sales? I'm missing. That's what I'm missing. Tuesday's data. We need to go back to Tuesday. I'm sorry. So let's go back to to Tuesday. I didn't go far enough back in my data here. How about Great Britain? Average earnings, excluding bonuses in April, down from 2.7% to 1.7%. So not significant, but it's still a trend of falling wages or slowing wage growth. That's not falling, but slowing wage growth. German CPI year-over-year basis flat. And then let's see, retail sales. This is what I wanted to talk about. So retail sales came in year-over-year basis minus 6.1%. Now, if you recall, I misinterpreted Larry Kudlow's statement. So he said on a month-over-month, and I actually heard it. When I listened, I thought he said it year-over-year, and I didn't have the clip, so I was corrected. So whoever put that in the comments, the clip, maybe it was my wife or someone else. Thank you. I was wrong. So I guess Kudlow wasn't crazy. Maybe he was psychic. Maybe he saw the reports, but he did accurately state what he meant. So although I did state what I meant, which was on a year-over-year basis, this thing is not going positive. And sure enough, retail sales year-over-year basis minus 6.1%. Now, there's a lot of questions about this in terms of, well, was this rebound on a month-over-month basis went from minus 14.7 to plus 17.7? Is this inflationary? Well, not on a year-over-year basis. So let's look at the chart. So here we've got advanced retail sales, and you can see it just fell off the cliff. I mean, we're going back to the data beginning in 1993, and so you can see it's still in recessionary territory. It's just picking back up from that massive drop when everything was closed. The trend right now is what is more interesting. Will it maybe slow it down on its up move and then roll over and head lower? We don't know. But there's a lot of questions about where is retail sales going. Now, big friend of the show, as many of you know, Dr. Chris Dark, who hosts the Dr. Dark After Dark podcast that I did listen to his show this morning on the one about the Fed going burr or Powell going burr, something like that. Anyways, great show where he talks about money printing and why it isn't and how money can get indirectly when the Fed eases into the stock market. So if you haven't checked him out, you can find him on Twitter under Dr. Chris Dark, and then you can find where he's got his podcast at. Well, he and I were discussing the Red Book weekly retail sales, and almost nobody in the industry looks at the Red Book, except I think he and I are like the only two people that think it's actually interesting. And why do I like weekly data? Because it tells me what the eventual monthly data should say. And Red Book came in at minus 8.3 on a year-over-year basis. And so since this is weekly, it's a year-over-year from a week ago. And that's pretty interesting to me. And so we look at this and say on a month-over-month, it didn't budge. So if I click on this year-over-year tab, and I look at the chart and we can change it to a line graph, you can see the Red Book weekly retail sales didn't move. So we were kind of curious is Red Book right and there's going to be an adjustment down in the months to come? Is this a one-off move in the advanced retail sales, or is this the government data more correct and the Red Book is wrong? We're kind of curious. We think the Red Book might be right. And if it is, it's a big plus for the few of us who actually look at it. But let's continue on to see if this retail sales data is likely to extend. One thing we can look at is cash freight shipments. And cash freight is great because when shipments aren't moving, people aren't going to be buying. And obviously, if you're a store or retailer or wholesaler, well, you're putting orders in, and those have to be shipped by freight. The cash data did not budge in May. In fact, it fell from minus 22 to minus 23% on a year-over-year basis, whereas retail sales, excluding food services, popped back up to minus 1.4%. So the relationship between the two usually lends us to the fact that cash freight is right. So what could be the cause of this pop in retail sales? Is it legit? And the answer is, yeah, it actually is. If you think about it, more than half the people on unemployment are getting more income than they're used to because of the $600 federal bonus. Now, when catastrophe or strikes and people are sent home or things change and they're ahead, what's the natural tendency? Well, you assume that, hey, in a few weeks or a month, I'll go back to my old job, go back to my wages, everything will be fine. I've got extra money. So what did people do? They did three things. They saved it, they spent it, and they paid down their debt. The question isn't what they did last month. The question is what they're going to do this month going forward. And why is that? Because according to my calendar, we're less than 6 weeks away from that $600 weekly bonus going to zero. And that means, assuming the same people stay on unemployment, their income is now going to be lower than it was before. Now, if you're on unemployment right now, you know obviously that states are reopening and stores and businesses are starting to reopen. And if you're not getting called back yet, but your coworkers are, what are you going to do? You're going to check in with them. Hey, are you getting your old hours? Are you going to get your bonus? Are you seeing sales good? You're going to find out. And guess what? People are probably finding out. Yeah, hours aren't there. Everything is going to be less. So the question is, as we get closer to that July 31st date, assuming there's going to be no renewal of it and Congress isn't going to come out with another stimulus package, will the consumer change his or her mind? Will they start saving more of it under the anticipation that they may not be going back to work? And if they are, that they already know that not only they're going to be at a lower wage because they're going from unemployment wage back to their old wage, but they're going to have fewer hours. Because remember, most of the people that got hit in this first round were those who did not have a college degree. Those positions are generally not salary, they're generally hourly. Maybe with a bonus, but generally hourly. So if you're used to working, say, 36 hours a week, maybe now going forward you'll only be 32. So the question is, will consumer behavior change? That's what we need to look at from a macro perspective. Let's keep going. Now, so why didn't freight shipments go up? Well, businesses had plenty of inventory. If you go to the inventory to sales ratio, now this is as of April, what you can see is inventories relative to sales, highest level ever. So retailers did not need to order anything. They had plenty of inventory. This was a good reason for them to get their inventory down. And so that is also another factor here. And one that was printed in today's Breakfast with Dave, for those of you are subscribers, which is probably not many because it is expensive. It is a subscription service, and so I can't actually show you his comment. But what he said was that in June, which is this month, 30% of Americans didn't make their mortgage payment. Let me say that again in case you missed it. 30% of Americans didn't make their mortgage payment. Now, when do most mortgage payments occur? First of the month or first few days of the month. Do we now believe that we're going to see a repeat of that strong retail sales surge if 30% of the people aren't making their mortgage payment? Because maybe they believe their forbearance is going to be extended. You know, it is important to understand that these payments are still due. Even if they're on forbearance. Forbearance doesn't mean that you get to put at the end of the mortgage. Maybe that's partially why we're seeing so many people trying to refi. What it means is you owe them when the forbearance period ends. So if you were in forbearance for 3 months and missed 3 months of payments, at the end of the 3 months, you owe 3 months of payments plus the current month. So my thought is if 30% of people are not paying their mortgage, they're probably not going to be spending much anymore. That perhaps that was a one-off month. I'm going to go with that. We'll see if I'm right or wrong. And let me clear that out so we don't inadvertently upset Mr. Rosenberg by accidentally showing his report. All right, let's go back to the data. All right, what do we have next? Capacity utilization rate. This is how much of a factory is being utilized. So if we go to the CAPU chart, what we find is that capacity utilization of factories is at the lowest level since 1967. And it currently printed 64.8%. Now, for anyone that's thinking inflation is coming, let me explain to you what this chart is telling us. It says that if you own a factory, that only 64.8% of your factory is currently being utilized. That's not inflationary. In fact, that is deflationary. And if you overlay Treasury yields to this, I'll show you. But what is inflationary is when factory utilization is at 80-some% or higher. That's inflationary. And you can overlay Treasury yields here, my favorite thing in the macro world. And we'll stick them over to the right. And you can see when capacity utilization falls, yields fall. And yeah, capacity utilization is probably going to rebound a little bit, but don't expect it to rebound a whole lot, at least not based on what we've seen so far. Let's continue forward. So capacity utilization is telling us weakness there. So factories aren't moving much product around. How about industrial production? See, now this is where we start to see some data that says, hey, there's a turnaround, because if retailers needed more product, they would go to their wholesalers and say, I need more product, and the wholesaler didn't have it. What are they going to do? They're going to go and call the factory and put in another order. So we should see it starting to see a turnaround in industrial production. Well, in May, industrial production improved slightly from minus 16.25% to minus 15.27%. So if we look at that, we don't need to be experts in monetary policy or macroeconomics to see that when industrial production heads down, you're in a recession. So this is not good. There's no V-shaped recovery in industrial production. In fact, it was only a slight improvement. That's your V. Looks like a fishing hook. No V-shaped recovery here. How about manufacturing production? Well, it improved. Let's see, month over month. It improved month over month from minus 15.5 to 3.8. That's not bullish either. That's telling you there's only a small improvement. Again, a fishhook improvement in the data. So retailers did not have a reason to order more product because they had plenty of inventory. Let's move to today's data since I was off there a little bit. So we've got mortgage applications increasing, which is notable to me that both purchase and refinance applications are headed higher. I know why refinance applications are headed up. I get that. I'm just surprised that maybe there's a lot of people still moving. I find it very interesting. Now, one thing to understand is if people that are overly bullish on the housing market, think about this. If you're going to move in the next, 5 to 7 years, what don't you do? You don't refi your house. That doesn't make any sense at all. Why would you pay the refi cost to move unless you are being forced to move? So when you see a big rise in refinances, guess what people are likely to do? Stay put. That would put downward pressure on new home purchases. So let's look at the data and see what we found today. We had housing starts and building permits. So let's just go to housing starts on a year-over-year basis, or not a year-over-year. But look at that, just like industrial production, boom, headed down. Is there a V-shaped recovery? No, there's a fishhook recovery. No V-shaped in housing starts. How about building permits? Now, building permits lead generally housing starts, you would think, because if a builder puts in for a permit, they probably are going to build the house. Well, it improved more than starts, but it still looks like a fishhook. No V-shaped recovery here at all. So that's pretty interesting. What else do we have? Crude oil data. So we saw crude oil inventories rising, although the market was pretty much ignored that because gasoline inventories did finally go down. The market was hoping for that. And distillate stocks, where are they? Finally dropped after hitting, I think they're at near record or at record inventory levels. But one thing that's notable is that crude oil refinery runs were down a little bit. Distillate fuel production was down, and gasoline production was down. So for whatever reason, and I'm not sure if there's some maintenance season or what's going on, or if refiners are really shutting things down, but you can see utilization rates for refineries were cut in almost half. So once the refineries move back up, and let's take a look at their week-over-week trend to see if we can see anything of interest here. And yeah, nothing real clear here in terms of what's going on with the refineries to give us any sort of prediction. So sometimes it's worth looking at data even if you don't quite have the answer that you're looking for. All right, now let's get to the main question of the day. Let's go look at some charts first. We'll come back to that. I'm going to think a little more. What did Powell do to screw up? What did he do? So we've got to look at Treasury bond prices. because again, where we're going to go with this is all about Treasury bonds and how stock prices are headed lower and Treasury bond prices are headed higher, because we're still in a massive deflationary shock that is yet to come due to Powell's big mistake. We'll see if you figure it out. So we come back to Monday, where we were holding support at this dashed line, and then all of a sudden, boom, retail sales data, and the market just gapped down on Tuesday, and prices held their 100-day moving average. Now, I'm not big on moving averages in terms of trading them, but they are, in terms of the market perspective, an area of support or resistance. So here we see that they held their 100-day moving average. We're looking at TLT, which is the effectively inverse of the long 30-year Treasury yield. And then today, it started down at the 100-day moving average and moved higher due to a strong 20-year Treasury auction that happened. So again, our bond prices are holding support. I still believe we have much, much higher to go because I feel that yields are too high. And why is that? Well, simple. You got to get interest rates down to get people to spend. So if this is a one-off retail sell support, there's your case for lower interest rates. If it isn't, then perhaps we have the beginning of something different, but it doesn't seem likely, because if I was a retailer and I saw all this demand coming, I would be pushing that out and getting more supply. We're not seeing the supply chain moving at all. So I look at the bond market, and now I've got to answer the question, what did Powell do or not do? What was his big mistake? And to that, we have to go to World Dollar Liquidity. Now, for those of you who have not heard of World Dollar Liquidity, I suppose I should see if I have my chart on that. It's worth a quick review. Yes, we do. So we'll unhide that, put that here, and I will switch you over. Here's World Dollar Liquidity. So a quick review. How do we get inflation in the global economy? Well, it's simple. U.S. consumers buy foreign goods with borrowed money. Goods or services travel to foreign countries. Look, get dollars in the hands of foreign countries. Mainly, particularly, preferably with borrowed money. Those dollars flow into the foreign companies. Now, they don't need all of those dollars. They might need some of them just for purchasing things on the international market, but they can't pay their employees or rent and all those things with dollars. They need local currency. So they exchange whatever excess dollars they have with their local bank, who in turn exchanges their excess dollars with their foreign central bank for local currency. So dollars start stacking up at the foreign central bank. Now, the foreign central bank doesn't need all these dollars, and the more it gets, the more inflationary it becomes. So to tamper the effects of inflation, the foreign central bank comes to the U.S. Treasury auction and buys U.S. Treasury bills, notes, and bonds. The U.S. government, who needs to run a deficit, this is required in the World Dollar Liquidity cycle, then runs a deficit, spends that money into the real economy, where hopefully consumers then get the money and move it around until they buy foreign goods and services, and the cycle flows. Now, this is very important because this chart tells us when we have inflation or not. And currently we don't. So one thing is, from the macro perspective, we need to look at how world dollar liquidity, is it getting repaired? Is it contracting? What's going on with it? And we haven't had an update in several months. I'll tell you why. But let's start with the beginning. So the easiest way to tell world dollar liquidity is to look at the monetary base, because world dollar liquidity is the sum of the monetary base and foreign held treasury securities. And if we look on a year-over-year basis at the monetary base, we can see, hey, look, during the great financial crisis, world dollar liquidity would have shot up, and looks like the Fed's being successful. It appears they're being successful. But let's look a little deeper. Now, on Monday, we looked at the major foreign holders of Treasury securities, or what's called the TIC data. And what have we seen? We have seen the amount held by foreigners drop considerably, from about 7 trillion all the way down to 6.7. And they seem to be selling. So here, let's do a little test. Do you think when foreign central banks sell Treasury securities, should yields go up or down? What do you think? Up or down? And if you don't know, just pick one, because you got 50-50 odds on this one. How about this? When foreign central banks sell U.S. Treasury securities, it is, boom, bearish for yields. What? Okay, Steve. Now you're really gone too far. How is it that somebody can sell U.S. Treasury securities and you think interest rates go down? Okay. Because no one else thinks that. I guarantee you, nobody else thinks that. Let's come back to world dollar liquidity. How do dollars get into the foreign economy? Well, when consumers buy foreign goods and services with borrowed money. And so when foreign central banks have too many dollars, what do? They buy Treasury securities. And when there's too many dollars floating around in the global economy, what direction are the yields headed? Boom, up. You see, what's cool about this is things are backwards from the way you think they might be. Isn't this awesome? Now, think about this. If there are too few dollars in the global economy, foreign central banks need some dollars. Now, why would they need dollars? Because they're getting demand from foreign companies. Why? They need dollars too, because they have dollar-denominated loans and they're not getting enough dollars from global trade to pay them. So they go to their bank and say, hey, we need some dollars. And they go, hey, we need some too. And the foreign central bank says, we don't have enough. So we'll sell some Treasury securities to get you some dollars. So if there is a dollar shortage in the world dollar liquidity cycle, that means yields are going down. Pretty wild, huh? Didn't see that coming, I bet. So that's what's interesting. A lot of people get this backwards. All right. So the fact is, when you see major foreign holders of Treasury securities selling, it is actually bearish for yields. Now, we have not had an update on world dollar liquidity in a while. Not because I haven't checked the chart, because it wasn't updated for the fourth quarter. And I believe whoever updated it forgot to post the update because we got the fourth quarter and the first quarter all at once. So when we start to add, and I want you to think about this, the Fed increasing the monetary base plus the decline in foreign held Treasury securities, it tells us a lot of interesting things. So here we have the chart, but let's put it on a year-over-year basis so we can see what's going on. And we see there's not a significant increase in world dollar liquidity. We say, well, there's an increase. Yeah, but you got to understand, they've got to undo this massive thrashing and destruction of dollars. This little increase isn't enough. They're going to have to go way up here at some point. Because look, this is what they did before the great financial crisis. This is what we had to do to fix it. Then we went on this long spree of destroying dollars, contracted it twice, and now we're going to have to go off the chart to get it back. And what's cool is everybody thinks stocks are going up forever. Yields are going to go up. And they're totally wrong because world dollar liquidity tells us Powell screwed up. And what did he do or didn't do that Janet Yellen would have done? Do you get it now? More QE. That's the only thing that can be done now. Is Powell still doing QE, but he scaled it back. He is not doing enough. Look, Janet Yellen would have literally put the pedal to the metal. It would be like taking lighter fluid and spraying it on the grill. You know she would have done it. Powell backed off. Big mistake. He's going to have to do more later, and he doesn't even realize it yet. Because what he has done briefly helped. But it's not fixing the problem. And the reason we know it's not fixing the problem is what? The foreign holders of Treasury securities are dumping bonds. And that is bearish for yields. And guess what happens when you get more QE? You get lower interest rates. Why? Because you need lower interest rates to get American consumers to go borrow money and buy foreign produced goods and services. And when you get more QE, you get two important things. You get lower interest rates and lower stock prices. And that's the macro view. See, that's the long game that people can't see right now. They're so fixated on the short game that they don't see what's going out there. And let me show you why. Because when you take this world dollar liquidity cycle chart and you overlay the VIX, which is a volatility index, and when volatility rises, usually it means stock prices get ripped in their face was ripped off. So here you can see when world dollar liquidity declines, usually, here there was a brief spike, it means volatility falls, usually. But when world dollar liquidity rises and rises rapidly, From what? Quantitative easing or future QE that we haven't done, volatility spikes. Here you can see it rose here, volatility spike. And here you can see Powell's going to have to do way more, and there's going to be a face-ripping vol spike coming. And when that happens, it causes interest rates to go down. When there are big spikes in world dollar liquidity, it sends interest rates down. Here you can see spike in world dollar liquidity, interest rates went down. Spike in world dollar liquidity, which is going to go way off the charts, interest rates go down. And this is important to understand because some people say, there's no money in the bond market. Well, a positive return is a lot better than what's coming in the equity market. See, equity people think stock markets can go up because QE makes stock prices go up. No, QE causes vol spikes, big ones, because nothing in the global economic data other than this recent retail sales report, which based on all the other circumstantial data says it was a one-off event. So Powell is doing nothing but maintaining a level QE plan. And the economic data is saying we are still short dollars. We're still short dollars. You didn't fix it. And that means he's going to have to do more. And that, my friends, is the long game with macroeconomics and long-term investing. You see what's coming. So some people are like, how do you know it's going to play out? I've seen the movie before. I've looked at the data. I know the ending. I've watched it. I know what it is. I know how this ends. It ends with a massive spike in volatility, a face-ripping crushing of stock prices, and an outright collapse in Treasury yields. And if you understand that from a macro perspective, and hopefully today's video helped, what you realize is that the positive carry is in the bond market. And if you have a positive carry, you'll be in the equity market at a much lower valuation with more money than you had today. I'm Steve Van Metre. Thanks for taking the time to watch. Hopefully you learned a lot today, and I'll be back soon with some questions that you asked. Bye now. The content of this video is provided as educational information only. Is not intended to provide investment or other advice. It is not to be construed as a recommendation or solicitation by our security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre. Personal capacity opinions expressed in this video that do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.